Good afternoon, everyone. Thank you for joining me. My name is David Scherer. I'm co-CEO and co-founder of Origin Investments. We've been writing an article. Initially, it was just me. Now it's Origin cumulatively for about the last 5 or 6 years. And then we started doing grading of that article. So in other words, the 25 predictions ultimately were graded. Now we're into the 26 predictions. And more recently, we've introduced this idea of a mid-year update, mainly because the last 2 years have been incredibly volatile, in particular in March and April, which is interesting. A year ago, it was the tariffs and everything that was happening, which sort of culminated in April of 25. And this year, obviously, it was the Iran war and the effects on inflation. And so we're doing a mid-year update. Interestingly enough, many things really haven't changed much, which is interesting. I think you'll find very interesting. But some have. And then ultimately we'll do a year-end grade as well, which we always do. And we'll have a webinar, but also we'll do a written article. So I'm going to get started. The format, I think, is going to be about 35, 40 minutes of presentation and then Q&A. We had just over 700 registrants, so thank you for spending your time with us. Many of you are partners, some of you aren't. We're more than happy to have this conversation with the industry, whether you're a partner or not. And then the Q&A feature, hopefully you see it. There were 30 questions emailed in prior. I'll answer those, and then obviously any live questions. I don't have a hard stop. And so I was just educated by our marketing team about attendees. I can actually see it, who's here live. And as long as there's attendees and you're interested and engaged in asking questions, I can go over an hour as well. So let's get started. That was the disclaimer. Please read it. That is me, probably a few years ago. I think I've aged a bit. But let's go to our first prediction. And all of these predictions correlate with an article that was published at the end of 25. So it's literally, we're just going to go right down the line. I believe there's 11 predictions. So the first is AI will disrupt employment and productivity without impacting GDP. That's happened. There's a lot of noise in GDP. Certain quarters, for example, Q1, tends to be very low GDP and Q4 is very high GDP and it undulates. But when you consolidate it, it's pretty remarkable how stable GDP has been and is projected to kind of be even into this year. On the employment side, I didn't really talk about employment, but the most recent unemployment numbers have been quite good. But if you go back, 5 months, 4 months, 3 months, they were sort of trending the other way into more unemployment, but then it's sort of turned around. There's just a lot of noise. I do think that, my opinion, I get this question a lot, and we can probably handle this more in Q&A. My opinion is certain industries will be disrupted by AI more than others. The obvious is it's very difficult to disrupt healthcare. It's very difficult to disrupt K-12 education. I believe that won't really change much, but it's easier to disrupt a lot of the financial service jobs, any job that's really predicated on information and accumulation of information. And so, but then on the other side, you have to think about, will AI also produce jobs in the sense of more innovation, lowering the cost of starting new businesses? There will be an element of that too. Let's talk about computer coding. That's been quite disrupted already by AI. And that obviously is a job killer. But then on the other side, if you can start companies that used to require huge computer programming upfront costs, and now they're lowered, it could produce more innovation, which produces jobs. It's unclear to me which will happen. But I do believe if I was forced to guess, I think the first effect of dislocation of jobs will be seen before the innovation effect. So another way of saying, I see unemployment ticking up based on AI, but then probably going down over 3 years, 4 years, 5 years. But I think in the next few years, you'll probably see the first effect happen before the innovation effect happens. And then, of course, the other part that needs to be addressed is what is the government going to do? Claude just came out with a new model, and the government has limited their ability to do certain things with the model based on safety concerns and its effectiveness at finding weaknesses in software systems. And so I think more and more the government will need to wake up, whether it's from a security issue or from an employment issue, or candidly a tax issue. If we're able to produce more GDP with less labor, that is a tax issue because our labor system is based on taxing wages, not production, for Social Security and Medicare. And so that will become a real issue quickly. The government's behind, as they often are. The innovation is faster than the government can react. But I don't think that it's reasonable to believe that AI will change the economy so much without the government getting involved. And I see that as something that will happen in the next 12 to 24 months. It's starting to happen, but I think it'll pick up steam. The second prediction, Origin's target markets are positioned for a broad rent recovery. This is happening now. This isn't a prediction anymore, and it's very simple. We've been saying this for about 18 months, and candidly, we were early. The supply wave took longer than we thought. A lot of it was delayed for various reasons, but it is now bottomed, and it's starting to come up. And this is, there's a lot of different ways you can look at this, but for example, publicly traded apartment REIT stocks, they're up 12, 15% in the last month. I'm not an apartment REIT stock analyst, but my guess is they're looking at this data and seeing that, concessions are actually starting to burn off. Supply is really waning. If you're new and you're not a current client, when interest rates were essentially zero for about a year and a half, 2020 into early 22, it created a huge wave of development. Development models look really good with 0% interest rate. You're borrowing at a spread above that, but let's say you're borrowing at 250 to 3%, like 2.5 to 3% on development. It's going to make models look good. And there was too much supply started. To be clear, we're underhoused in the US. We still are. But there was too much produced at a moment in time. And so like the metaphor I've used a lot is it's like a snake eating an elephant. Like the snake eats the elephant, it's really full. And then a couple months later, it's really hungry, but there's no elephant. Like that's where we are in multifamily. Like there was too much produced. It's now been absorbed and there's no next wave. Because what happened was in 22, the Fed starts raising rates, development goes down, new starts, right? So the starts in 22, 23, 24, they didn't happen. There's about a 2 to 3, sometimes 3.5 year lag between when you start and deliver. And then when Silicon Valley Bank failed, it really stopped because those regional banks are a primary lender to construction. And when they saw that bank fail, everyone sort of panicked and sat on cash, wouldn't make loans. And so it exacerbated what the Fed was doing. So you could argue it helped because the M2 and M3 money supply went down even more. There wasn't multiplying effects there. So where we're sitting at now is the beginning of what I believe is a very bullish cycle in rent. I think you're going to see rents go up a lot in the markets I'm listing here, but really nationally. I think it's going to be a national trend. And when people start to look at solutions, there won't be solutions because the supply that we need should have started in 23 to deliver in 26, but it didn't. In 24 to deliver in 27, but it didn't. In 25 to 28, but it didn't. And I'll get into some of the data on it, but as long as demand stays where it is, and when I'm making these predictions, my assumption is demand doesn't go up or down. It stays where it is. One of the reasons I get a lot of these predictions correct is there's a lot of inertia in financial markets, meaning if you're going to step out and say there's going to be a big change, you're probably going to be wrong. Like more oftentimes than not, what you see is what will then be the next reality too. And so my assumption of a static demand curve is really based on, there's a lot of noise in the economy, but the reality is unemployment is kind of where it was. And that's a big driver. So number three, I did get wrong. I said interest rates will hover between 3.6 and 4. At the time I wrote the article, I believe they were between 4 and 4.1. Believe it or not, and I've been pretty consistent about this, I have been saying basically for 2 years that I think that the forward SOFR curve, in other words, the expectation of the Fed and what they're going to do, was way too bullish. People were assuming the Fed was going to cut rates aggressively. I've always been much more cautious of that. I didn't think inflation was low enough to believe that they were going to cut rates 2 or 3 separate times. Or I believe the market in December of last year thought between 3 and 4 rate cuts this year. So the expectation now is essentially 0 rate cuts all year. So massive change in that expectation. And the market believes there could be a rate hike. And what you really need to look at, it's quite easy, rather than look at the whole SOFR curve, and just look at the 2-year note yield. Right now SOFR is between 3.55 and 3.75. That's where the Fed is setting that. And the 2-year note yield, I believe this morning, is 4.05. So the expectation of the market is the cumulative return over the next 2 years at the front end will be 30, 40 basis points higher than where we are today. And so that's been a massive, massive move. If you looked all the way back to December, the 2-year note yield was probably 3.5. I don't have it in front of me, but if someone has it, check it, tell me. It's been a really big move. Now, the far end of the curve, interest rates today, I believe the 10-year note, that's what I look at the most, is right around 4.45. It got as high as 4.65. It's come back down, but it's up 40 basis points from when I wrote the article. Obviously, when I wrote the article, the big change, and it's here on the slide, is the Iran war, conflict, whatever you want to call it, which started, I believe, late February, early March. It apparently has been somewhat resolved, and there's an agreement now. So if in fact that's true, and there's not more disruptions to oil, it normalizes, oil starts flowing through the Strait of Hormuz again, and there's not a toll of some kind. It's a little unclear to me if there is a toll or isn't a toll, or how much the toll is. But let's assume there isn't, or it's small. The rates can normalize back lower. So the case for lower interest rates, but I'll just tell you now, based on that shock, I would raise everything 30 basis points, right? So if a range was 3.6 to 4.6, I think based on what happened in Iran, the long-term inflation ramifications, I would move that up to 3.9 to 4.9. And so that's where I am, and that's why I was incorrect there. The other thing that if you're going to make a case that rates are going to go down, I think it would be the secular effects of AI produce deflation. It's that simple, right? You're able to produce more at a lower cost structure. That is the one of the big benefits that they're, saying AI will bring. If you believe that, that isn't a business cycle change. That's a permanent. When I say secular, I mean permanent. It's a permanent move into a more deflationary place. If you believe rates are going to go higher, I think the biggest reason that would happen is we just have too much debt. We're 40 trillion in debt. How are we going to refinance all this debt? We have deficits on top of debt. And if you think about the average duration of our debt is about 3 years. So if you think about that, 12 to 13 trillion dollars have to be refinanced every year. On top of that, you've got deficits. We run deficits too. So let's say your deficit's $1.5 trillion, and then you got to refi another 13. That's a lot of bonds that need to be sold every year. Who's going to buy them, right? So the answer has been throughout time, people buy them. Countries, pensions, sometimes our own Federal Reserve. So for people that have been incredibly bearish because we have too much debt, they were bearish when we had 5 trillion, 10 trillion, 15 trillion, 20 trillion. They've been wrong for 20 years. Interest rates have stayed low. I don't know how to predict that. Like the rational side of my brain says that should produce higher rates over time. But I would have been wrong for 20 years. So it's a very difficult one to get your hands around. But you have to be aware, based on how much debt we have, there's always a risk that the cumulative market will say, I don't want to finance that much debt. That doesn't seem like a good investment at 4.4 or 4.3 or whatever it is. One of the reasons we win is, as bad as our situation is, it's better than other countries generally. And so we tend to win on a relative basis, but maybe not on an absolute basis. Fourth prediction, multifamily fundamentals will strengthen, affordability gap will stop expanding. So this is a huge input into our demand curve. I talked earlier about why I believe, like the base case and all of my assumptions are the demand curve just holds static. It doesn't get higher or lower, it stays where it is. We're seeing record absorption, meaning more people are choosing to rent than they ever have. Why is that? Well, one of the reasons that's happened is there's been this very recent phenomenon. And what I find fascinating about this graph is it was essentially parity. If you go back to Q1 13, parity, and then all the way to 21, it's essentially parity, meaning it's the same cost to rent than own in our markets and nationally, et cetera. And then you see this massive dispersion and it's stayed there. And so today, it's 56% more expensive to own than rent. Of course, people are choosing to rent. It's a rational decision, and a lot of times, it's the only decision. You don't have the ability to pay 56% more for a condominium than a like quality, likely located unit in Nashville, rental unit in Nashville or Charlotte or Denver. Anecdotally, we've had professionals at Origin that do very well move to these growth cities. And they've had a really hard time buying a starter home. It's very hard because you have to come up with a down payment, the monthly payment when you price in taxes and HOA and insurance and mortgage. The mortgage is 6.5%, 7%. Very hard to make it work. And even myself, Origin just opened an office in Miami. Actually, yesterday was the first day. And so I moved and I'm in Miami and I looked at buying and renting and I wound up renting and I'm renting a wonderful condominium. It's 45% cheaper for me to rent than to buy this unit. It's for sale. But I ran the numbers, same numbers, like, okay, I'm going to put this much down. Here's the HOA, here's the mortgage, here's the insurance. This is my monthly payment and my rent is 45% less than that. So, everyone, whether it's me or an analyst who's 4 years out of school, everyone's making the same decision. The prediction I made was the affordability gap will stop expanding, which has happened. You see that it's flattened in 25 and it's come down a little bit. And I think it's going to continue to flatten. And the reason is because I think rents are going to exceed appreciation of homes. And so it's going to happen the right way. We're going to see rents start to really increase. That's very good for us. Obviously, it's not as good if you're a renter. But I think the world of kind of the free lunch, you're going to rent at 56% cheaper. I think that world will end, and we're going to have a nice, 3 to 5 years of rent growth. Multifamily investment activity will rebound. This was also accurate. This is actually refinancing activity. When I think about multifamily investment activity, there's refinance and there's sale. I mean, those are the two ways that people move capital through this. There's been more refinance than sale activity because I think owners also see the fundamentals increasing, and they want to try to maximize value, and they believe that staying in them longer is the right thing to do. Multifamily valuations are flat to lower than where they were 5 years ago. And this is an asset class that has kept up with the S&P for the last 50 years. And in the last 2 years, the S&P has gone up dramatically, probably 50%, and we're flat. And so I think that there's going to be mean reversion, meaning that you're going to see multifamily valuations go up again. And I don't have a prediction about the S&P. I don't. But I do know that if you look at the long-term average, this would be an interesting time to rebalance portfolios. And I think you're going to see, I know that on the equity allocation side, there's much more equity interested in multifamily now than even a year ago or 2 years ago. It's completely changed. So that's also something to keep in mind. We have, I believe, 130 investment advisory partners, just meaning partner firms that invest in one or several of our funds. And so myself, my partner, our teams are always talking to their CIOs or their CEOs or their advisors about what they're seeing and what they're doing. And it's changed a lot. They're very interested in getting into the multifamily space again because it's seen as a protector and grower value, and there just hasn't been increased values in the last few years. The other thing I would take out of this chart is because this is measuring this remarkable pickup in refinance activity, you have, if you look at, there's banks, CMBS, insurance, financial, government agency, and other. And so where we sit is in the private lender space. We originate multifamily loans, bridge loans, and construction loans. And what's really happened is because the banks really haven't been active enough, and some of the other traditional lenders, we're seeing tremendous volume in the space at really interesting levels. So the way that this is set up has been very good for that deal flow and that sort of opportunity set. So developers starting projects now will be best positioned for success. This is something that we've been talking about quite a bit. I mentioned it before, but again, remember there's roughly a 3, perhaps 4-year lag between when you start a development and when you deliver the finished product and start renting it. And so here you see this sort of corroborates what we were talking about before, the quarterly supply. Now remember, the stuff that started in 2020, it's going to start delivering in 23, 24. By 22, you've kind of, you're in that rate hike cycle, SVB, bank fails. And so just look forward 3 years. The 2020 stuff is 23, 24, the 22 is 24, maybe into 25. And you just see the slope fall off a cliff, right? Like this is where we're at right now. This is quarterly supply, annual inventory growth, and we're in this downslope where we're undersupplied as a whole and not enough started in 22, 23, 24, 25. So in my estimation, this is a very good time to start new development. We are starting new development, both for our Income Plus fund, which does 20% of its investable strategy is development at all times. And so lots of our developments have been stabilized and rented. So now we're restarting new development, and I'm very bullish on those deals. We also have a select asset fund that's all market rate development. And then we're looking at QOZ 3 development as well. There's a very interesting deal right now in Phoenix that we're looking at. So there's lots of ways that we approach development. We are one of the larger developers in the country in our market. At any given time, we have between 8,000 and 11,000 units, either in pre-development, development, lease up, and that's both common and pref. So we have a large team in this area, lots of data, and if there's opportunity in that set, we'll find it. When I say 10,000 in development, generally, the construction type varies, but I would say generally it's around 300,000 a unit. So you're talking about $3 billion in development now, right? So we're very large, and we have a really large data set, and I like where we're positioned right now in the cycle for our clients. Multifamily construction costs will remain flat over 2026. Now, remember, I made this prediction in Q4 of 25. That was before the Iran war. So am I going to change this? And the answer is no, I'm not. We just actually published an article on this. Bill Stewart, who leads our construction team, wrote an article. It's fantastic. We'll share it if you haven't read it again. But I believe it came out about a week ago. We're not seeing this. It's very counterintuitive because you hear about input costs, and oil is obviously an input cost to other costs. But the bottom line is the average construction costs around our markets are actually decreasing, and they still are. The reason is there's two inputs into construction costs. One is the headline. You say, oh, well, oil, inflation, costs must be going up. The other is actually the margin that a general contractor or a subcontractor is willing to take a job for. And that force is actually more powerful than the input force. When we're going to bid out contracts right now, this just happened in multiple markets, but I'll name one. In Florida, we have an opportunity zone deal just outside Tampa, and we went to bid that best and final going to GMP, guaranteed maximum price. We were able to get that down another 5 or 6%. The subs and the contractors, the GCs, they're not busy, and they don't see a pipeline of future deals to start, and so they don't have pricing power. And this is an amazing moment in time because you're actually getting good construction pricing and strengthening fundamentals at the same time, which is a very good combination for the expected value of future development. Another thing I like about what's happening right now, both on our stabilized assets and our development assets, controllable multifamily operating expenses are stabilizing. They're actually going lower, which is incredible. So candidly, they went up a lot in 21, 22, both controllable and non-controllable, right? Non-controllable would be insurance and taxes. I mean, you can appeal taxes, but they're largely non-controllable. Insurance, you have to have it. Those went up a lot, but those have also come down a lot. Certainly, I shouldn't say on the tax side, but on the insurance side, we've had actually deflation of insurance costs, which is really good to see. And then on the controllable, they've also come down. What this means is at every given unit of revenue, we're able to pull through more cash flow, right? There's more net operating income. So very happy about this as well. I don't think that this will continue. I don't think this is a trend. If you see it going down, we're going to wind up much, much lower. But, you know, inertia is a real thing. Like if it flatlines, like I think that's more likely, but that's a very good outcome in a rising rent environment. Credit spreads will widen moderately in 2026. When I write about credit spreads, I'm talking about multifamily credit spreads. So because we're originating loans and we're buying bonds, we're an approved buyer of, for example, Freddie Mac K-Series bonds. So we do a lot of that activity. That's what I'm measuring. And lots of our portfolio, the way that it's valued is, it's actually valued by the trading desk at our at the investment banks that custody our bonds or provide lending to our bonds. So it's done regularly and it's done in a very market-based way. And so you've seen a slight uptick. I would say anecdotally, it's not even this high. I would say minus this graph, what's really happening is it's the same. They haven't gone up or down, they've kind of stayed. But what's interesting is they've stayed at an incredibly tight level, right? So that like kind of zoom out, you've seen it as high as 650 over, you've seen it as low as 300 over. It's kind of, it's showing here that it's 375 over. It's more like 3.25 right now. And this is very, very different than lots of our competitors who aren't lending on multifamily. I would call it hard asset collateral. You know, if we ever have a loan that they're not able to repay, we take a building back that's built and cash flowing and has real intrinsic value. If you lend to a software company and they're not able to pay you back, you might also have the risk that the IP that they had that produced the cash flow is also worth very, very little. So you don't really have recovery cost. And that's what's happening in the EBITDA-based space. That's why you have real concerns in that area. We're just not seeing that here. It's very, very difficult for multifamily valuations to go down 35%. It's not impossible. I'm not saying that, but I think historically it's never happened. So you can take whatever, but I can tell you this: the reason we got into this space, Tom Briney brought me this idea in early 2020, and at the time, if you remember, with COVID, Congress had put an eviction moratorium on multifamily, and so people were struggling with, including us, everybody. Like, what's going to happen when renters don't have to pay their rent? They can't get evicted. They can stay as long as they want, but we have to pay the mortgage. How does that work? And so what wound up happening is people found out that people do pay their rent, even when they don't have to. They still do it. 95% of people paid their rent nationally when they didn't have to. And so it was sort of a social experiment. And so we were presented this space at sort of this time of distress. And when we started talking to Freddie Mac, it's very, very difficult to become an approved buyer of Freddie Mac bonds. They've vetted us for over 2 years. And we came to them with the criteria they needed: national operations, 15 years experience in multifamily, over 10,000 units, scale, capital, everything they're looking for. Still took us 2 years. Because when you're a buyer of this part of their bonds, you have control over any loan that goes wrong. Like, you're expected to protect the bond, and they want to know that you know what you're doing. And so, we got into that space. But what got me excited about the space all the way back to 2020 was the loss rate on their loans. Now, to be clear, the Freddie Mac loans are over 30 million. They're big. They're 30 million a loan, 40 million a loan, 50 million a loan. And so the borrowers are sophisticated. They're not small borrowers that bought a 3 flat or 4 flat and they're renting and they're figuring it out. This is Origin is the borrower, Blackstone's the borrower, Starwood's the borrower, Camden's the borrower. Very large teams with trained professionals running these things. And so, as you can imagine, when you take large economies of scale projects that are well built, well located, with borrowers that know what they're doing, the loss rate is going to be really low, and that's what attracted me to it. The loss rate, I believe they started the program in 1994, was below 0.1%, and you had, at the time, you had 26 years of data. The size of the market's large, so you're talking about $50 billion of loans a year, every year for 20. So like, I'm a data nerd, and so is everyone at Origin. And when you dig into data sets that big and you see that the loss rate is that low, that's very compelling. And then you say, okay, well, what can we produce in return, and what does it look like for an investor, right? And it kind of looks like 10%, like that's what you do. The other thing that's interesting about this fund is, now that the tax bill is permanent, there's a 20% reduction in dividend tax for real estate collateral, and that's permanent. And so if you're getting 10% in this fund, and your tax rate is, let's just say for argument's sake, 35%, you're going to save 0.7%, right? Like, it's going to feel not like 10, it's going to feel like 10.7. And so it's a remarkable perk, because credit isn't tax efficient. You can't depreciate, you're not in that equity position to do that. So all those reasons make it compelling for me. Multifamily capital will continue consolidation towards larger managers. I don't really have a statistic on this. This is a 25-year trend. It's very difficult to do this work at the highest level if you're a small manager. And it's also difficult for investors, because small managers tend to have higher costs to you that sometimes aren't seen. If you have a very small fund, there's still activities that have to happen that usually are amortized over a larger fund, but it's a small fund. So, the audit, the client relations, the client admin, communication, accounting, like all of these things can wind up being much, much more expensive than you think, to the investor. I would just say that. And then from the owner's standpoint, the manager, you have to constantly attract and develop and maintain the best people. And it's difficult to do that at smaller firms because you don't have the scale to compensate, to develop, and to retain. So, I talk about this all the time. Origin has become, I would say, a middle size to maybe slightly bigger than that. We're certainly not Blackstone. We're not huge. We're still middle manager, I would say. We have $2.5 billion of equity, depending how you measure it, 6 to 8 billion in assets. But we're big enough to attract and retain, and we've been able to do that very well. The people that made the decisions 10 years ago are still here. And then what I'm really proud of is the new group of professionals who have been here, 7 years, 8 years, 5 years. For example, I'll call him out. Preston, who's joining me in Miami, he's going to be our acquisition officer in Florida, working out of our Miami office. He's been at Origin 5 years, and he's been through our entire training program for analysts, and he's been prepared now to become an acquisition officer, and he's going to do great. But like that you need a bigger firm to be able to provide that infrastructure to do those types of things. Maybe another example would be Tom Briney. Like, how do you keep Tom Briney here? He's so talented. He runs credit. He came over from Blackstone in 2011. It's 15 years ago. And now he's running credit. Well, we have to grow in order to maintain people like Tom. They have, he's 10 years younger than me. He's not 55, he's 45. And Preston's probably 30 is my guess. Like, it's my job and Michael's job and the leadership of the firm. Like, we have to make sure that these really talented people, Phil Schuholtz, who runs our Texas operation, Jacob, who's running our Western operation, you can't replace this type of talent. You have to have platform opportunity for them, right? So that's a key element. That's why I think it's so hard. It's hard for the client because they pay a lot. They don't realize it, but they do on these smaller funds. And then I don't think you're getting the best talent. It's very hard to do that. You might wonder how we did it, because we were small ones. The reason we were able to do it so successfully is the Great Recession presented that opportunity. Because entire firms were failing in 08, 09, and 10. That's why people like Dave Welk, who's running equity at Origin, or Mark Turner, who came over from Equity Office, or Tom Briney, who came over from Blackstone. It was a moment in time where you could get those people. Like otherwise, you're not getting those people. So I don't have data, but I have anecdotes. This is continuing, and it will continue. The last prediction, and then we'll get to Q&A. QOZ investors will wait on the sidelines until 2027. This graph shows it really well. Massive interest in sort of the early days, 2019 to 2022. Just under 33 billion was raised, and then from 22 to now, so essentially 4 years, you've had 10 billion, right? So 33 billion raised in 2 years, and then 10 billion raised in 4. And if you look at the last, really, like from March 25 to current, it's almost zero. Like, it's completely flatlined. And the reason is the maps haven't been redrawn. So there's, people don't know where the next QOZ deals will be available. But the other reason is until January of next year, you don't get the 5-year deferral. You don't get the step up. You still get, today, you would still get the big benefit, which is no cap gains on the new investment. But the other gains are significant, or the other advantages are significant too. If you have a large capital gain bill that you can defer for 5 years, there's a huge advantage to doing that, right? That capital is in your pocket and you can hopefully invest it, at some return. Maybe it's risk-free, it's 3.5%, or if you put it into equity, it could be whatever it winds up being. So there's real advantages to holding that money. I think that QOZ will rebound next year once the deferral is reinstated. One really interesting thing that we've learned in the last really few months is that QOZ projects that are in process now will get, if you have capital that needs to go into a QOZ, whether it's July of this year, September, January 1st of next year, if you want the deferral, which, you can wait and you can still get the benefit of these QOZ in-process projects that are in the old map zones. So we learned this because we have a QOZ deal in Old Town Scottsdale, and it's a little bit too big for our QOZ fund. So we were raising a small sidecar, and through that process, we learned about this benefit, because there's no way that this deal is going to survive the remap. Old Town Scottsdale is a super vibrant, very high-end area of Phoenix, and I would argue one of the nicest areas of Phoenix. But it was, the old maps were based on the 2010 census, and so when you're thinking about Old Town Scottsdale, don't think about what it looks like today. What did it look like 16 years ago, right? And so that's a big benefit. It's not just Origin, because we have some of these deals that are in process, meaning we're actively working on them. They have business plans. We're going through pre-development. We're going through the process necessary to ultimately get debt and equity. Those will be deals that do comply for new capital for the next, let's say, year. And then it'll revert to the old maps, or the new maps, sorry. The new maps, I haven't seen them yet. They haven't been drawn, but I've seen indicative maps. It's going to be, based on a much more recent census, and, the AMI requirement is lower. So long-winded way of saying, it's going to be difficult to make the new maps work. There will always be exceptions, but the exceptions will be provided by local municipalities that layer on their own incentives to make them viable. I don't think there's going to be a lot of deals that are down the fairway market deals without local incentives. There's also an element of the new QZ law that incentivizes rural QOZ. You get a 30% reduction of your, they call it the step up, but it's a 30% reduction of your original capital gain and the deferral. Those obviously won't work with multifamily because we need people. People need to be in areas to rent. But they possibly could work for, other niche QOZ businesses. Not my area, but I'm thinking of, a soybean plant, a pipeline. There's other things that don't need people, and they could comply, and that would be interesting, but obviously outside of Origin. And that's it. So I'm going to go into Q&A, and please continue to send in your Q&A. I'm going to start with the live Q&A, and I'm also going to go to the presenter tab. No, attendees tab. Let me see here. Okay. Yeah, awful lot of attendees still on. So great. We had 700 registrants. I don't know how many folks have been on, but there's over 180 on now. So we'll just continue until you drop. Okay, so I'm going to start with some of the live, and then I'll move to what was sent in. So Megan, yeah, you asked two questions. Let me go down. Oh, you asked more. Oh, wait. Megan works at Origin. Sorry. Those are mailed in. Okay, so Glenn asked about the recording. Of course, you'll receive the recording and the presentation. So I'm just going to go next. Ken Greenspan, thanks for your question. I've heard there was a huge apartment building boom in the last 2 years to capitalize on the high rents. I've heard some places now. Yeah, so Ken, the apartment boom you're talking about happened in 21 and 22. Lots of those deals were postponed, and so they delivered 25, 26. So you're seeing very old supply that's hitting now. No, the new starts they've fallen off a cliff. And so we're going to have the conversation very soon. I would guess it's next year or even late this year. The new conversation is going to be, why are rents going up so much? And we need to do something to produce affordable housing. Like that's the next conversation we're going to have, because there's not enough supply coming, and it's 56% more expensive to own than rent. So you're gonna have a very different problem. It'll be good for us because we own the asset, but it's going to be very bad for inflation, right? Because rents are a huge input into the CPI, and you're about to see rents go up a lot. And it's going to take time, because if you think about a lease roll, we have leases that expire every month. So if rents are going up, and they're going to go up, it doesn't happen in 1 month. 1/12 happens next month. The next 12th happens the next month. So it inches over time, but it absolutely will happen. John, thanks for your question. I never know whether to say the last name or not, so I won't. I did last time. The press is full of stories about flat to nominal rent growth. You're predicting robust rent growth. Can you explain? Absolutely. I think I just did before. It's a lagging index. We have very little supply that's going to hit over the next 3 years. Demand's at a record high. Rent to owning spread couldn't be wider, 56%. So I believe that you're at the beginning of a very bullish cycle in rents. And by the way, we're not always bullish. 3 years ago in 23 and 24, we came out and said there's going to be negative rent growth. No one in the industry said that. One firm did. We did. And so I'm not always bullish. I was actually quite bearish. And our more importantly, our company and our AI was also seeing this. Our AI it produces one output, and it was very, very negative. And so we wrote an article about it. Like we go on the record and take the risk. I'm telling you, I'm taking the risk now. You're seeing a moment in time, rents are going to go up. I'm going to mispronounce this, but Iguel Khan, I really apologize about that. As compared to multifamily, isn't office REIT poised for growth in the next 12 months? I don't know. I don't love the fundamentals of office over time. I think that what's going on in AI is a demand eroder of office. There has been normalization of work. We do 4 days at the office nationally. We have 6 offices, but nationally, people need to come in 4 days a week. I think lots of firms have done that, but that's not an area I'm gonna, spend a lot of time on. I'm not bullish on office fundamentals personally. I also don't love office fundamentals from a cash flow standpoint. You tend to always collect less cash than you think in that space because of leasing and tenant improvement expenses, et cetera. I don't love it. However, one thing I do like about office is the valuations are so low right now that certain deals could be interesting. We're not going to do that. We do one thing, and I like our lane. We're an expert in all phases of multi, whether it's owning, operating, developing, lending. It's a big market. It's plenty. But yeah, some of these office assets they used to be $200, $300, $400 a square foot, and they're trading at less than $20 a square foot. So all the equity's been wiped out. The lender's probably taken an enormous hit to their loan. There are office investments, if you're a distressed investor and a contrarian, that might be worthwhile. You have to understand at 20 a square foot, it isn't what you think. You have to re-tenant the building, and that might take time and cost 150 a square foot. You have to look at the stabilized basis, like not just what you're buying, but what you have to put in. Byron asked a question. So your company is a multifamily lender. Yeah, we're a very large multifamily lender. We do both refinancing and construction loans. It's our fastest growing business, and the expected value is amazing for our clients. That's why I'm such a large investor in that fund. And we publish, by the way, we publish our returns, our Income Plus fund. Income Plus is on our website. We publish it every quarter, and we compare it to all of our competitors, the largest and also indexes. So we're a big believer in transparency. These are trailing returns versus their trailing returns. It's fair game. And I think you'll see we've greatly outperformed everyone over the last 1, 3, and 5 years. Glenn Henry, thank you. Thank you. I think that's a sign off. I probably should check. Okay, we're down to 158. Santiago, could you elaborate on the exit strategy for this multifamily asset? Santiago, I don't know which one you're talking about. Maybe you can mention the asset, and I'm happy to answer it. Chip Zahn, based on low construction costs and strong fundamentals, do you see your select fund outpacing some of the projected returns? Chip, I view the world as probabilities, right? And so the way I would answer your question is, I really like the vintage of our select asset fund. That is a market rate development fund. We have 3 seed assets now that are under control, that are coming in at a cost structure we like and an expected value we like, into strengthening fundamentals. And so like when I look at it, I look at the base level return and I see a tail to the upside. And that's how I would answer that question. Like the base case is the base case. And then there's a scenario where if cap rates stay the same, forget about them going down and going lower. We always assume cap rates are higher when we exit, but they don't have to be higher. Like what if they just stayed the same? And what if fundamentals improve slightly? Yeah, you could easily get an upside tail that's into the mid to high 20s IRR. And I say that because we did development from 2013 to 2020, and our average return was mid 20s. And I think we're better at development than we were then. So like development is a vintage based fund. And my advice to investors in development, if you want to have that in your portfolio, I would suggest that you ladder the vintages. You would invest some, if you, just for argument's sake, if you wanted to have eventually 500,000 in development, maybe you do it over 3 years. There's a 26 vintage, there's a 27 vintage, there's a 28 vintage. I guarantee you there's very wide dispersions in those outcomes because the delivery market's always different. Where are interest rates? Where are cap rates? Where are rents? Where are OPEX? Because all that follows into NOI, which is the capitalized EBITDA. So I would just, sometimes people in development, they have too much vintage risk at a moment in time. And so, but I do like this vintage, to answer your question. And I'm investing significantly in that fund. Grant Wood, thanks for your question. Does immigration policy impact future demand projections? And then you asked another question, but let me answer that one first. Again, my future demand projections are demand is flat. And so there's lots of variables that affect future demand. There are variables that could increase it. A strong economy, an increase in immigration also increases demand. And obviously, a weak economy would be the opposite. I don't know the next business cycle. I don't know when the next recession is. I don't know, even with immigration, I don't know where immigration stands long term. We know where it is today at a moment in time, but leadership changes. So my base case is flat. And so there's a lot of noise. My demand curve assumption's flat. With a new office in Miami, how are you looking at the reduction in net migration to Florida? There was a reduction in migration everywhere that was in the growth market in 24 and 25 because there was this renormalization of work and people that were virtual were asked to come back. My belief is that the long-term migration is going to continue. People will continue to move to low-cost, low-tax states. And Florida is benefiting the most from not just migration, but also the type of migration. The type of folks that are moving there is significant. So I'm not concerned about that right now. Carol Radomski, thank you for your question. How are you thinking about cap rates today and exit cap rates if the long end may be expanding? And I think when you say long end, you mean interest rates. So right now, cap rates haven't moved up, even though the risk-free rate moved up. So that doesn't mean they couldn't, but right now we're really active in the 1031 market. Those are stabilized assets, and we sell assets too. So we're a buyer and seller of stabilized, really super high quality multifamily to scale. Cap rates are still in growth markets. And when I talk about cap rates, I'm going to talk about stabilized cap rates, because a lot of times deals will trade at, in the low fours, but the buyer is assuming concession burn off, and in a stabilized world, they think that it's 4.7 or 4.8, right? So just understand that there's a lot of noise in cap rates. I'm going to use stabilized to try to smooth that. But cap rates are, kind of 4.6 to 5.2 stabilized based on the market, the location, the quality asset, et cetera. Phoenix tends to be one of the lower. Austin's very low on a non-stabilized basis, because there's the assumption that you're going to see a turnaround. But we just haven't seen it. We haven't seen cap rates go up. Now, remember, a cap rate is the terminal value of a building. It's the terminal multiple placed on, all income streams forever. And so, yes, the borrowing rate affects it, but the growth rate affects it more. And so if there's a belief that long-term growth is durable, cap rates don't have to go up in a rising interest rate environment. That's what we're kind of seeing right now. So I said earlier, Carol, in our models, we model a 10% increase in cap rates in our development deals. And that's just it's a margin of safety. So if we're trying to develop to a 6.2 cap, we're assuming that, by the time we sell 4 or 5 years from now, and by the way, when we're developing to a 6.2, we believe that the spot cap rate is 5, right? So then when we're looking out into time, we're saying, okay, when we sell it, it'll be 5.5. That doesn't have to happen, right? And so when you're looking at our projected returns, in a way, you could say, well, can a cap rate go up, down, or stay the same? It should be sort of an equal probability. We're assuming base case is 10% higher. And so another way of saying that is we're potentially understating our returns, but it's a way that we provide a margin of safety there. Daryl Adams asked a question, for the Income Plus Fund, is the Nashville Infill project still in the pipeline? I think you're talking about, email me offline, because I'm not, or re-ask the question. There's quite a few deals that we're looking at in Nashville. And one of them is actually going to go into the Select Asset Fund. So if you're asking for our development pipeline, I'll have our team provide that to you. That's going specifically into Income Plus. Just shoot me a note. My email's right there. So why have concessions been elevated? Again, Jed, good question. It's because the supply was slower in delivery than we thought. And this was a mistake we made, and we've talked about it before. Our AI was using the standard construction time to come up with the assumption on supply over time as it was delivered. And what wound up happening is a lot of these deals got delayed. Sometimes it was because construction costs were too high, and then they had to be sort of re-engineered. Other times it was lenders. There was a lot of reasons. Other times it was the cities. The cities had so much construction start in 20 and 21 that a lot of their functions got overwhelmed, inspectors, et cetera. And so the delivery of supply took longer because they were delayed. And then what we did to the model to address this in the future is we're not making assumptions anymore about how long a garden project takes to build, or a podium project, or a wrap project. We're actually going to be using satellite data that shows where they are in construction. And so it's a little bit more expensive for the model to do these things. We have to pay for that data. But now we're going to be able to see where they are, not where historically they should be. Because there was a big divergence between what historically a stick-built garden project took to build and some of these outliers in this cycle. Danny Shackelford, you mentioned the great opportunity in new builds, but will the stronger fundamentals also help with existing investments? Yes. All these fundamentals will help with QOZ1, QOZ2, QOZ3, Income Plus, even our lending funds. People are able to service debt more readily when cash flows are higher and operating incomes are higher. The answer is absolutely yes. We've been, if people want to know what a stress test looks like in multifamily real estate, we've had it. It's been a 4-year stress test. You can see by the returns we publish, Income Plus did 21%. That's that fund lends. It develops 20%. It owns and operates assets. It did 21% in 2021, and then it fell down to 8, and then it fell down to 7, and it's kind of been hovering around 7. Essentially, it's the dividend. The dividend is plus or minus 6%. We've raised it consistently year over year, but I believe that fund is due for tailwinds. We haven't written up assets in 4 or 5 years. We've actually written them down. So you really it's cash flow, and it's the expected value of debt that's producing those returns. I believe there will be a very good period. It's a great entry point into that fund from a performance standpoint, in my opinion. Bella asked a question, what about the cost of money to fund the projects? I'm not sure if you're talking about debt or equity. So if you could specify. I will say on the debt side, Bella, the spreads are quite tight in terms of like the lending spreads. So anytime you lend, there's the risk-free rate, and then there's the spread above that, right? Because you have to be paid for risk. And the spreads have tightened in our space. That's all the way back to the slide that I was mentioning, the credit spread slide. Multifamily credit has been remarkably tight. It hasn't moved out. EBITDA-based credit, the spreads have moved out quite a bit. There's a perceived risk in funds that lend to EBITDA, and there's been a huge rotation into what we do, where people say, wait a minute, assets that have been around forever, and it's a hard asset, and if you take it over, you own something of value forever. There's been a realization that maybe that's a better form of collateral than a cash flow stream secured by technology. That technology by definition is disruptible. I mean, the technologies we have today were the disruptor, but now they're being disrupted, and maybe AI itself is disrupted. I don't know, but it seems to be that's the realization. John Simpson, thanks for listening in, John. What risk, if any, does your team assign to a project's rent growth being frozen by local or state governments? John, we invest in areas that we don't believe will be in those situations. If you think about where we invest, North Carolina, to some extent South Carolina, but not a lot, Georgia, Florida, Texas, Arizona, Utah. The only state I would say that gives me a little pause is Colorado. Colorado is a purple state, and they're having an affordability issue on all sides, rent and for sale. Obviously, worse on for sale. So those are those are things we're talking about. I talked to Michael and Dave Welk about that this morning, because we're looking at a 1031 there that is quite interesting. It's in a irreplaceable location, best market in Denver. It's Cherry Creek, but there's some things that it doesn't feel great in terms of where they're heading. So it's something we think about. It's also why we left Chicago. We don't invest in Chicago anymore. There's lots of good reasons to invest in Chicago, but the reason you wouldn't is it's a very Democrat-run city. I'm not against Democrats. I'm very much a centrist, but you know, blue cities tend to move in these rent control directions. And also Chicago has a very difficult balance sheet. And so it's a lot easier to raise taxes on a few capitalists that own large buildings than spread the pain. So that's a risk I can't predict. So I'd rather not be involved in it. And I don't think cap rates reflect the uncertainty in these areas. So you take your ball and go somewhere else. So that's my answer, John. Like I hear you, but there's a reason we're not in New York. There's a reason we're not in California. That's a big part of it. I don't want to lose in areas we can't control. E. Lynn asked a question about build for rent versus multifamily. Build for rent right now needs clarity from the House and Senate on the affordable housing deal. If you haven't been following it, and by the way, we do a lot of build for rent, and so we're very much in this. And I like build for rent. It's a horizontal multifamily strategy. It requires a lot of land. You have to buy the land at the right basis, and the land has to be well positioned for growth. I mean, you don't want land that isn't at least drivable to quality retail, you know, in a short period of time. So once the House and Senate finalize that, I think build for rent will really start to pick up again. But right now, part of that bill, the Senate introduced a provision that build for rent deals had to be exited unit by unit to individual buyers within 7 years, and that's just not that's not tenable. We can't invest in build for rent and have to sell 200 units to 200 buyers. There's operational problems with that. There's actual tax problems with that. So that's where we're at. But the House took the Senate's version and struck that out. But now it's sitting in between the two. I don't think the provision will come back, but it's still not finalized. We need clarity. And the irony in all this is, some of you probably had the interview. I interviewed the chief economist from the National Association of Home Builders about a month ago, and you know, he's brilliant. We'll have him on again. He's terrific. But the National Association of Home Builders opposes this bill. Think about that. It's a bill that's supposed to produce more housing. They oppose it. Like that's how far we've gone from, you know, and the logic's really simple. If you want to reduce rent or the cost of housing, you need to produce more housing. You need more supply. We don't have enough supply. I've already covered that the future supply isn't going to happen because it didn't start when it should have. 22, 23, 24, 25. We've already missed it. And so now we have a bill that's going to future limit supply because Origin won't start new build for rent with this uncertainty. And so like it's a good example. Again, I'm a centrist, but this doesn't make any sense, right? If you want to reduce cost of housing, you incentivize new supply housing. Like that's how you do it. Farad Bunyadi, thank you for your question. Does Origin invest in advanced construction technologies? Not directly, but my partner and I, Michael, we're in 3 separate real estate venture funds where we get to see. There's really only 2 that kind of lead the space in real estate venture. And one of them we've been investing in for probably about 8 years. So we see all of their investments and all of the, and so for example, many of you have emailed me in the past about 3D printing of homes. We were the seed investor, that the fund was, I should say, in that technology. They're based out of Austin, and just an example, but like that's why we invested in it. It wasn't really for returns for us. I mean, it's obviously nice if we make returns on our investment, but it was mainly because we want to always be at the sort of vanguard of innovation. And innovation takes a lot of different forms. We built our own AI. We've talked about it a lot. We just hired an external firm to produce AI for the whole company. It's a little bit different. It protects our data as we use external AI. It encrypts it, but it also allows us to organize and sort all of our company data. The AI we built was rent predictive analytics AI, and now it's decision-making AI that we use as a tool at all of our investments committees. But we're always going to innovate, and innovation is both AI, but sometimes it's physical. You know, modular housing. If they ever figured that out, like that would be really interesting. We've been looking at it for 10 years. It kind of still hasn't proven to me to be scalable and cost reducing, but it could be. Okay, I am still going on live questions, and I want to make sure that people are still on. What's going on here? Attendees down to 89, so we'll keep going. Okay. Oh, okay. Thank you, Daryl. You re-entered. Thanks for your question. The Select Asset Fund. Yes, the Nashville infill deal is in the pipeline for the Select Asset Fund, and we're finalizing that joint venture agreement. I don't know if I can share our partner or not. I don't want to get in trouble, but they're a top 5 national developer, and we're super excited about that deal and the fundamentals. The key to that deal is it's in a really good location. They got a great price on the land, and we're able to do surface park, which makes our basis much lower. But my and Origin's experience over the last 20 years in development is if you can get service park deals at the right price, you're at lower basis, but the renter doesn't really care. They don't care that you're surface parked or you're structured parked. And so you're getting similar rents, and your OPEX is lower too, because service park doesn't require any OPEX. So your NOI and cash flows and stabilized cap rates are just higher. So I love well-located surface park deals. The key is getting the land at the right price, and they did, because it requires more land to do that. Fong, I hope I said that right. Tran, thanks for your question. What annual rent growth are you underwriting today? How does that compare with historical? It varies by market. When we look at rent growth, we generally are using our own AI. It's called Multilytics, but we also look at other sources. And in particular, we're looking at the comps in the market. We don't like to see annualized growth above 3.5–4%. So if the Multilytics output is showing that, we're going to spend more time on it. Historical, just give you a frame, over the last 100 years, rent growth nationally has been plus or minus 3%. So the further you move from 3, the more you have to look at it a little bit. There's some gut checks here. But you also have to remember, we're coming off flat to negative rent for the last 3 years. So the affordability ratios are quite favorable right now. I didn't talk about that earlier, but wages are up and rents aren't. And so the affordability ratios, you kind of want that to be below 25%. And, in a lot of our markets, they're low 20s, meaning there's a lot of buying power for renters, which positions you well for this. So, as an investor, if you're looking at deals and they're in the 30% or higher affordability ratio, you have to really question those assumptions. Sometimes it's because the neighborhood's gentrifying and there's a new renter coming in. And so what you're seeing today might be very different than the renter in a year or 2 or 3 or 4. but you need to do that work. And if it's above 30, the work has to be done to try to figure that out. Another question, Fong, where do you see the greatest risk to your current outlook? The greatest risk I see, I'm paid to be nervous all the time. And hopefully you've seen that Origin and I act. I don't just feel nervous, I do something. I'll give you an example. I couldn't sleep in 2021 because interest rates were zero. And everyone was saying at the Fed that inflation was transitory. Didn't feel transitory. It felt much worse than that. And so, we did large swaption hedges on our portfolio, and it wound up making our clients $50 million spread through our funds. And I say it made 50 million, but it really just hedged the higher interest rates, because we had to borrow much more expensive over the last 4 years. So it sort of netted out, right? We made a bunch of money, but then we lost a bunch of money on having to borrow higher. So I hope you see that I don't just observe things, I also make hard decisions. Right now, I'm ambivalent about interest rates. I don't know which direction they're going. I tried to touch on this earlier. There's deflationary forces of efficiency. It could be AI driven. It could be other reasons, but efficiency. And then there's inflationary forces, higher tariffs, higher oil, our endless need to borrow at the long end and the middle end, and just government debt in general. So I'm kind of ambivalent. I don't know which way interest rates are going. That's why I'm making the range around 3.9 in my prediction. We're right in the middle. We're at 4.4 in the tens. But I'm always nervous about interest rates. I can't control it. And then the other thing I'm always nervous about is just the business cycle. We haven't had a real recession in a long time. Doesn't mean I'm predicting one. I'm just saying we haven't had one in a long time. And anytime there's a recession, that affects demand. So remember when I said my presumption is a constant demand, in the future rent growth that I am predicting as baseline, I think there'll be rent growth. But if there's a recession, you see less household formation. Another way of thinking about that is, instead of renting an apartment, you and a roommate rent an apartment and you make it work because you're making less and maybe one of you doesn't have a job. And so now it should have been 2 apartments, but it's 1. Or you have a child that graduates college and they need to find a job and get an apartment, but they don't. It's a recession. So they move back in with you. Well, that's lack of household formation, right? Those are things that I would worry about. So those are the things I think about, but I'm presuming more of the same, right? I can't make investment decisions based on only bad outcomes, because there's also good outcomes, right? And a lot of the times what people don't realize is it's just as bad not to put money to work that would have made you money as it is putting money to work and always being defensive. And the one time it hits, you say, oh, well, see, I was right. I mean, Samzel, who was an amazing investor, don't get me wrong, but one of his REITs sat on $3 billion of cash. I believe it was Equity Commonwealth, for 4 or 5, 6 years, because he was convinced there was going to be this correction, but there wasn't a correction. So 4 or 5 years later, there's 40 to 50% you should have made that wasn't made. Well, what kind of correction does it require now, right? So you have to, generally markets, high quality markets like a multifamily market, a stock market, the S&P, they generally go up. And for people that sit on the sidelines and talk about, I'm scared, you should also be scared of inflation that's 3.5%, 4%. And every time you're not investing, you're not keeping up. Byron Thomas asked a question, how can I present a deal to me? Email us. We're always looking at deals. It has to be 200 units or larger. It has to be in one of our target markets. It has to be institutional quality. I don't know what, if it's a joint venture, it has to be with a tier one or tier two respected partner. I don't want to do deals with folks that don't have infrastructure and proven returns and all these things. And so if it's a general deal, that's easier because we're controlling it, but send it to me. Ty asked a question, is depreciation, hold on, sorry, I lost it. Is depreciation tax deduction benefit not applicable for availables in the credit fund? Exactly. We can't depreciate it all in a credit fund. You do benefit from the 20% reduction in dividends tax. And I talked about that before. At a 35% tax rate, you're going down to 28. So it's better than most credit funds, but you're not getting depreciation unless you're in the equity position. So that would be income plus. That's what's getting that depreciation. Okay, and I think that's it. Ty, you asked another. Eric, thank you for your feedback. Excellent presentation and discussion. Thank you very much. I really appreciate you taking the time. We're quite a bit over. We do have 74 left, so if you want to ask more questions, you can. Ty asked one last question. It appears today the market has been challenging. Thoughts on buying existing properties versus starting ground up? It's completely idiosyncratic, Ty. So what I find, because again, we're an acquirer of high quality 1031, newer built. And so we're looking at a deal in Cherry Creek right now. We're looking at a deal in Dallas right now on the Katy Trail. We're always looking. We just looked at a deal in Brookhaven, in Atlanta, in Raleigh. The nice part of that business for us is we have constant information flow of the highest quality deals and where they're pricing on a per pound basis, on a replacement cost basis, on a cap rate basis. And what I'll tell you is the highest quality deals in the markets we want to invest in are trading at or above replacement costs. So this idea that things trade below replacement cost, it's true, but they're not the best deals in the best locations. They're commodity products wherever they are. And they tend to be construction that either you wouldn't build again in that place. I'll give you an example. Unless you command really high rents, you don't want to build high rise because it's the most expensive construction. So if you find a high rise deal that's trading below, that's not as relevant as you think because no one would build it again, right? It's not, what is relevant is if there's a huge demand and there's huge rents and people want to start on high rise and you're buying it below. I get that. That's not what I see. And so I would tell you it's idiosyncratic. You have to do the work. There's no blanket statement I can make about should you develop or should you buy. The answer, unfortunately, is it depends. Those are last chance. Oh, there's more. Okay, Josh asked a question. Will income plus fund always be tax efficient? Josh, that's the goal. And I think the answer is going to be yes. And the reason is our 1031 program, we call it DST, it rolls into income plus, excuse me, after 2 years. And so we're constantly going to have really high quality, stabilized rental buildings that are being efficiently tax exchanged. So in this case, the fund gets the 1031 and the owners of the 1031 get shares in the fund. And so you're always going to have new depreciable assets that come into the fund. And then, of course, it's our job as a portfolio manager to make sure that we have credit and development that also is constantly being started so that the expected value of the fund moves up to 9 to 11 annualized, which we will do, right? So the fund will grow over time. The assets that they're going to be efficiently acquired into the fund that are depreciable are combined with credit and development as well. And so you see that happening in the fund now. We're sort of rebooting and restarting our development sleeve, and those are very high expected returns. James asked a question, when will Nashville and Charlotte roll over into Income Plus? 2 years after the last equity was accepted. I mean, those are the rough IRS guidelines that we want to comply to. And so by memory, I believe that was in Q1 of this year is when those both finished that raise. And just a little bit about our 1031 program. That's a space we entered 2 years ago. It's a new business, and it really provides two benefits for investors. One is because we have so many investors that we have relationships with, we have 5,000 investors at Origin active and 130 investment advisory firm partners. We don't need to use intermediaries. We don't need to use brokers to find the 1031 capital. And what winds up happening is the investor in the 1031 or DST, they wind up getting in at, a front end load or fee at between 1% and 2%. A lot of our competitors are quite a bit higher. Some are 5, some are 10. So think about that. If you have $1 million investment, at Origin, you're paying $10,000, $12,000, $15,000 up front, and maybe somewhere else you're paying $50,000 or $100,000. Like it's a massive difference. The other benefit is after 2 years, you go into the Income Plus fund. Well, we publish those results, so for the past 5 years, you go to our website, you can see them. We've outperformed all of our competitors over 1, 3, and 5 years. And so you're getting into a fund that's greatly outperformed. And, we believe it'll continue to do that. So what's happened when you combine those two things, very efficient fee structure with a high performing fund on the back end, we're the leader in multifamily DST already. Like over the last 2 years, it's a brand new business. We've done, I believe it's 138 million, and that's higher than anybody. It's higher in Blackstone, it's higher in Starwood, and I'm really proud of that. We're getting great feedback that what we're doing is of value, and that's what we try to do at Origin is provide a value that's palpable. I don't have any other new questions, so I'm going to sign off. I know it's approaching 2 hours at this point. We will send the recording, and if I didn't answer your question, email me, david@origininvestments.com. I tried to stay on as long as people did. We still have 66, so thank you for staying on live. You're always welcome to email me. I might respond, and I might send you to somebody who's candidly an expert in that space and can respond better than me. So have a great rest of the week, and we'll talk soon. Thanks.